The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. For decades, Asia's export-driven economies followed a predictable playbook. Sell goods to the U.S., then funnel the proceeds into American assets, especially government bonds. But that long-standing cycle is now showing signs of unraveling. Amid growing fiscal concerns, rising yields, and a reassertion of America First trade policies under Donald Trump, some of the world's largest money managers warn that a massive unwind of the U.S.-bound capital is only just beginning. This so-called Sell America moment is rattling markets, weakening the dollar, and prompting investors to reallocate to Europe and beyond. So what's driving this realignment of global capital? How far could it go, and what does it mean for U.S. financial dominance? Well, to find out more, joining me now is Danish Lim, who's a senior investment analyst at Phillip Nova. Danish, welcome back to the show.
Hi, it's great to be back here.
Thank you so much for joining us. Danish, Sell America sentiment is growing among international investors, it seems. So for some background context here, walk us through the concept of Sell America and what are the key forces driving it right now?
So I think it's very simply just a term for a broad rotation out of US dollar assets, probably mainly treasuries, bonds, and as well as broad, US tracking ETFs. And I think the key idea is that the dollar, as well as treasury bonds, viewed as having lost their appeal as safe havens. And it's quite strange because investors typically flock to treasuries as a safe haven, especially during periods of market turmoil. But since early April or so, after Trump imposed his reciprocal tariffs, instead of rising, we actually see that treasuries actually followed risky assets like stocks lower. 30-year yields, for example, went as high as 5.1%. And this is very unusual because during the global financial crisis, we saw treasuries rally. So even on September 11th, treasuries also rallied. And usually a higher yield will result in a stronger dollar. But this time, the dollar fell, while the yields actually rose after April 2nd. Okay. So there are, I think, 3 or 4 key forces. Firstly would probably be, concerns over Trump tariffs driving inflation. Second, and probably the biggest reason would be the fact that I think, everyone knows that the U.S. owes a lot of money. Its national debt held by the public is around $9 trillion. And still, I believe, centered around the possibility that Trump's policies could further build up this national debt. And, if the economy enters a recession, fiscal spending will have to increase, and that will further increase debt.
Okay. So does this signal a whole change in narrative around U.S. economic, exceptionalism?
So I do think there is probably a change in narrative, but not an entire, upheaval of the dollar's status as the world's reserve currency. Ultimately, I don't think there is an alternative asset that provides the kind of liquidity and depth of the U.S. Treasury market. If you are familiar with the FX market, you will know that almost all major currency pairs involve the U.S. dollar, like dollar JPY, euro dollar, pound and dollar. So all these currencies are major currency pairs because the US dollar is involved. The data shows that dollar is involved in about 90% of FX trades in the world, and it accounts for about 59% of central bank reserves. So ultimately, I think the dollar, is still a premier asset, although I think it has become less safe. But there is really yet to be any currency or asset that can take its place other than maybe gold. So despite the challenges, I still think dollar will remain prominent in the near future. But I do think that all the factors I mentioned, like tariffs, US debt, it certainly does warrant a weaker dollar.
Okay, so how much impact does the Sell America move from investors have on U.S. markets?
I think, when you first took maybe finance classes in university, one of the first things you probably learn is the concept of a risk-free rate. And it's actually been ingrained in most finance professionals that U.S. Treasuries and the 10-year Treasury yield essentially benchmarks of what we call a risk-free rate, and Treasuries are the world's risk-free asset. But again, what we are really seeing in markets recently are that Treasuries aren't really seen as being, completely risk-free anymore. And this is very important because Treasuries, they are used to determine literally almost everything in finance, for stocks, to determine bond prices, to determine mortgage rates. And, even in Singapore, for example, a change in the US yield, in US interest rates, will result in a change in our own local interest rates as well.
Right. So what specific U.S. assets are being offloaded the most?
So I think right off the bat, the dollar probably is seeing the biggest losses. It is down almost 9% year to date. Longer dated treasuries as well, treasuries 10 years or more, they essentially reflect investors' future expectations more than shorter dated treasuries. And these are seeing the largest losses. The equities like S&P 500 index funds also saw some slight pressure, but recently they have made somewhat of a recovery.
Okay, so with Sell America momentum in full swing, where are investors now taking flight to?
I think in terms of currencies, we are actually seeing investors flock to the euro, as well as haven currencies like the yen and the Swiss franc. And in equities, quite interesting because Europe actually outperformed most major markets in May, and German bonds as well were actually one of the main beneficiaries of the recent treasury turmoil. And of course, we have gold. Prices soared to above $3,000 recently. All these are probably seen as a credible alternative to U.S. treasuries, U.S. assets. And I believe this is why, investors are enticed to shift their allocations to these places.
Okay. Well, for decades, Asia's export powerhouses had a simple financial strategy, which was sell goods to the U.S. and invest the proceeds in American assets. Now, that model is apparently facing its biggest threat since the 2008 global financial crisis, upending the logic behind the $7.5 trillion of investments from Asia. What will this mean for the U.S. economy, though? How significant is this, Danish?
So I think this, overall loss of confidence in America, as well as more entities sell U.S. treasuries, there could be, a greater supply of treasuries, and this will ultimately lead to a plunge, in the prices of U.S. treasuries, resulting in higher yields, especially as the risk premium increases. And like I mentioned, this will ultimately result in higher mortgage rates. Borrowing costs will increase as well.
Well, some of the biggest or world's biggest money managers say an unwind is just getting started. To what extent could this unwind deepen, and what would be the worst case scenario look like for the U.S. and global markets? How far do you think this sell-off could go if, current trends continue?
So I think the worst case scenario would probably be similar to what we saw in the global financial crisis, where we saw, Asian nations, they sold off probably around $1 trillion in treasuries. But the main reason they did that back then was essentially to, sell treasuries for cash. In such a scenario, we could see maybe about a 70 to 100 basis points increase in treasury yields. And typically when yields rise, we will see equities decline as well. And the main order of events would be one where bond prices will move first, and then equities will follow up, and then they will suffer the impact of higher discount rates.
Well, if large-scale divestment from U.S. assets do accelerate here, could we see major market dislocations?
Yep, definitely. If large-scale divestment occur, I believe we will likely see, the treasury term premium, treasury yields, all of this very likely to increase. Bond prices will fall, similar to what we saw really in the 2013 episode of the taper tantrum, where 10-year treasury yields increased by about 120 basis points, and this will ultimately result in a higher discount rate, wider credit spreads, and the S&P 500, could drop maybe about 10 to 15%. And, I believe tech stocks, growth stocks will likely suffer the biggest brunt of the selling, especially because they are more sensitive to interest rates.
Okay, well then what key indicators should investors watch to gauge how severe this might become?
I think the most important indicator would be, of course, treasury yields. Whether for example, the 30-year treasury yield, whether it, again, reaches the 5% level. There's also other interesting data. I believe the U.S. Treasury actually releases, monthly foreign flow data. We call it the TIC data, or the Treasury International Capital data. And I think it will be very important to essentially track the flow of portfolio capital in and out of the U.S. So if we continue to see, consecutive months of outflows, and I believe that's a very big red flag.
Okay. Well, on that note as well, Danish, how should investors hedge against this broader divestment from U.S. markets?
So I think a very simple thing is to just, own assets that benefit when the dollar weakens. For example, you have gold, gold futures. It could be gold stocks as well. Some of the gold mining stocks like the Newmont Corporation. And of course, you can even look to U.S. multinationals with a majority of their revenue, generated offshore. For example, Apple, for example, McDonald's. And of course, investors can also look to essentially shorten their portfolio's, exposure to duration. Duration meaning, their sensitivity to interest rate fluctuations. So in such a case, investors can look to assets like 1 to 3 year treasury bonds. And of course, a small allocation to Europe equities, Japanese exporters, who are all likely to benefit from a softer dollar as well. I believe one of the best performing stocks this year is a European stock called Rheinmetall. It's, I think, about 213%. It's up about 200% year to date. And, we also saw similar things happen to South Korean stocks, for example, like Hanwha Aerospace, Hanwha Ocean. All these companies are, major beneficiaries from a weaker dollar. And they also benefit from this theme of, weapons manufacture and defense.
Okay, very interesting. Well, Danish, what risks do you foresee then if this selling pressure intensifies, especially for retail investors?
I think the main risk, again, is duration. Investors should definitely try to limit their exposure to, interest rate fluctuations. As you see, recently we are seeing this massive volatility, especially in the US Treasury space. For example, investors should reduce any holdings they have in, maybe long-dated bond funds, and maybe also reduce their exposure to tech stocks, which are very sensitive to interest rates. And I think also, I'd really like to highlight that what we typically consider safe, which is 60-40 portfolio, when interest rates rise, they actually suffer the most. On both sides, the stock side and the bond side will suffer from higher rates. And we actually saw this in 2022 when the Fed started hiking rates. The classic 60-40 portfolio actually fell by about, I think, 16%.
All right. Well, overall, before we let you go here, Danish, is this Sell America moment a short-term overreaction or a longer-term realignment of global capital flows?
So I think it's actually, a bit of both. I think in the near term, it does look like yields will continue to go higher. But I think in the longer term, we are likely to see a slow but durable rebalancing of capital flows across the world. I believe that capital will be spread more evenly. I think also it's because, reserve managers, they have learned from, Russian sanctions that keeping all their reserves, in based on dollar, it carries a form of political risk as well. So I think the dollar in US markets will definitely remain the core holding, but maybe at 50 to 60% of global portfolios instead of the 70% that we're used to seeing.
Well, great insights from you there. Thank you so much, Danish, for joining me today.
Thank you, Hongbin. Thanks for having me.
Thank you. That was Danish Lim, Senior Investment Analyst at Phillip Nova. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.